Hi, I am CA Hemal Bhatt, founder of CredenceEdge Advisors. At CredenceEdge Advisors, we specialize in corporate taxation, internal audit, and strategic business advisory. We work closely with businesses, startups, and growing enterprises to bring clarity in compliance, efficiency in tax planning, and confidence in decision making. And in today's video, I will walk you through the complete framework of corporate taxation under the new Income Tax Act 2025 in a practical and simplified manner. From 1st April 2026, India's direct tax system is undergoing major transformation. The Income Tax Act 1961 is now being replaced by the Income Tax Act 2025. So the question is, what changes for corporates, what remains the same, and most importantly, how should you plan? Let's break it down. The new act focuses on simplification and clarity. Now there are reduced number of sections, introduction of a single tax year concept, and more structured and digital compliance. But remember this is not about increasing taxes. This is about making the system more efficient. Now let's talk about what every business wants to know, that is tax rates. And the good news is tax rates remain largely stable. Standard corporate tax rate is 25%. Tax rate under concessional regime is around 22%. Tax rate for new manufacturing companies is 15%. But here is the important shift, and that is MAT. Minimum alternate tax is now moving towards a final tax concept. Means there is no carry forward of MAT credit of earlier years. MAT will be considered the final tax. This changes how companies plan their long-term tax strategy. Another biggest structural changes is in TDS. Earlier Act had multiple sections, section 194C, 194J, 194H. Now one single section is introduced to cover all the earlier TDS section, that is section 393. This means less confusion, earlier compliance, better automation. Let's understand this with a simple example. If a company earns rupees 1 crore profit, under normal tax will be 26 lakhs. Under 22% regime, tax will be around 23.5 lakhs, including surcharge and cess. So there is direct tax saving of around 2.5 to 3 lakhs. Next example is about MAT applicability. Suppose if book profit is rupees 1 crore, then MAT at 14%, it will be around 14 lakhs. And now MAT acts as a final tax. This is a major shift in tax planning. Now let's think like business owners, not just taxpayers. So here are 5 key major strategies. Choose the right tax regime, optimize tax MAT exposure, leverage startup incentives, maintain strong documentation, and prepare for digital compliance. Because going forward, data analytics will drive assessments. So let's be very clear, scrutiny will increase, transparency will increase, and aggressive tax planning will reduce significantly. So what does this new law really mean? That will be stable tax rates, simplified structure, strong compliance framework, and for corporates, strategic tax planning becomes more important than ever. If you are a business owner, CFO, or entrepreneur, this is the right time to revisit your tax strategy. At CredenceEdge Advisors, we help businesses with tax structuring, compliance planning, strategic advisory. Connect with us for expert guidance. And if you found this video, like, subscribe, and share this with your network. Thank you for watching.